Good afternoon. This is Mr. Not Advice. It is Saturday, June 6th, and this is my weekend update. As always, this is for education and entertainment purposes only. Got a lot to go over today. We had a hell of a day yesterday in the market, but quite frankly, I think there's some, I don't know, well, usually when that type of shit happens, there's a lot of FUD thrown around and end of day shit, but it, I'm going to show you why yesterday was not the washout that everyone thought it was. Also going to go over the employment numbers as well as talk to you about why the reaction, again, that coupled into or compounded the market downturn. What were viewed as strong employment numbers, I didn't view them as such. In fact, if we look at the employment numbers, we had a economy added 172,000 non-farm payroll jobs, which significantly beat the consensus estimate of 80,000. So the thinking from the market was, well, there goes any chance of interest rate cut, because if the jobs market is strong, then you're going to see how does the Fed then justify cutting interest rates into that. And that helped push the market lower yesterday right off the bat. But when you drill into the actual jobs themselves, 70,000 of those jobs were leisure and hospitality, which I thought was a pretty strong number, meaning it was out of the ordinary. And then I realized why those jobs were being hired for the World Cup. That's a one-time job event, hiring, and we'll probably continue to see hiring in leisure and hospitality as states and companies prepare for the World Cup to be played in the US. If we take out those 70,000 jobs, then the US economy didn't add longer term jobs or longer duration jobs at 172,000. They added about 100,000 jobs, which would be a slight beat of the consensus estimate of 80,000. We take this a step further and we back out local government jobs of 55,000. And in fact, the jobs number would have come in under expectations, which certainly would justify a look forward view that interest rates would be cut sometime through the end of the year. In fact, we had both Kevin Warsh coming out as well as one of the Fed board members discussing effectively that they're going to stay neutral in how they look at jobs or look at interest rate hikes or cuts going into the future. So there wasn't as if they came out and said, yep, now we're going to have to hike. So I don't think that the jobs were the first thing, I guess, today that I would want to leave you with is I don't think the jobs report was as strong as the market believed. I believe that the market was looking for a reason, okay, to sell off, and it got it. And that's not a bad thing. There was it's funny, the market will talk about what it, when it's in balance, okay, when it's either too low, going too low, or too high. Um, the market will speak about, well, what will it take to put it back in balance? We need to sell off if the market's too high. We need a rally if it's too low. And then when that happens, the market participants then immediately start in with straight line extrapolation as if yesterday's action is going to continue, right? Unabated. We know that's not going to happen. So Trump didn't help, obviously, when he came out with a text which said, with a great jobs report like just announced, stock should be up, not down. That's the way it's been for 200 years. That was his first, and I don't think he had multiple attempts yesterday to try to goose the market. So my hope is also that that the market is paying less attention to his tweets and the market will trade on its own merits. But that's probably going to be something that ebbs and flows also. So let's look at the overall reasons or the message why the market dropped yesterday. It was the strong jobs report that the market viewed as bad news for momentum in stock markets because that increased rate hike odds. On the back of that, we had treasury yields soaring, the dollar moved higher, and precious metals and crypto got crushed. Oil traded down. This has certainly been the strangest pause in military activities. I don't remember. I think the name itself is pretty indicative of what you'd expect, which is ceasefire. And yet we haven't had a ceasefire. There's been continuing shooting across the strait from both parties. And I find it very interesting that I've talked to a couple people online where I wouldn't say talked to them, I responded to them, and they, the theories that well, oil is going to push to 150. And I guess where I'm at with oil is isn't right now the perfect scenario why oil, or perfect scenario for oil to be at a much higher level, 120, 130s. And yet it's stuck in this range of 90, $95 a barrel, which is still high, but it's not economically crushing high. So I um I find it surprising that people think that when the Iran conflict ends, oil is going to move higher. I understand what they're saying is they believe there's going to be a supply disruption they believe that the ongoing supply disruption is going to force oil prices higher, but behind the scenes there's something else going on. What's going on is and a lot of this I have to attribute to Mr. David Levinson because I think he spells it out quite well. Well, he spells it out. You have to sort of interpret what he says because he speaks in such a high level. But the long and the short of it is that oil will come down by the end of the year due to demand destruction. Demand destruction will occur because the US dollar is going to continue to strengthen against foreign currencies, especially emerging markets, Asia, right? And as the dollar strengthens, their currency gets weaker, so their goods become cheaper, right? So there's left less of a profit margin. As their currency becomes weaker, their central governments will step in to support their currency because they've got to support their export business, and they will start raising rates. When they raise rates, that will tampen down any demand, not any, but it will significantly tamp down the demand for oil as manufacturers and producers cut back due to the increased cost of materials for their products, which at the same time is happening when their products, due to weaker currency versus the dollar, their products are being exported for less money. So there's your demand destruction, and it's going to come out of Asia and the emerging markets. So the first thing that I think with oil is I do not think that oil is going to be rocketing up to $150 unless somebody drops a tactical nuclear weapon in the Middle East. So that's the first thing. Why I think this market is actually counterintuitively, I think we're set up for even stronger rally. But I think that rally will be in stages, perhaps a relief rally if and when the Iran war is truly ended, as well as on the macro fundamentals of the U.S. economy. We might be getting into a situation here, and I think we are, where everyone else does poorly, but the U.S. does very, very well. I little paid attention to tweet from Trump or comment was that he thought that things could get sorted out. He could wait as long as Labor Day. If truly he is prepared to wait until Labor Day, uh, that's going to significantly speed up the time when these emerging markets are going to have to step in and support their currency. It's just the name of the game. So that's why I think that with emerging markets, if they continue to come under pressure due to their currency, I think that you're going to also see gold and silver move down because such a great demand comes out of Asia and emerging markets. Let's not forget the EU has already stated that they intend to raise rates. And so remember when a country raises rates, it has the effect of being like stepping on the brakes for an economy. And it's not as if Europe is overheating right now. The war is having second level effects that myself included, if it wasn't for Levinson and some others that I follow, would completely miss. It's not as easy to say bombs are dropping, oil's going up. Well, as I said in the beginning, if in fact I would challenge any oil bull and say, well, aren't we right now in the most perfect situation for oil to be screaming higher? Why is it not screaming higher? We're going to get to that right now, actually. So obviously, I'm gonna start off with oil. This is an analyst at ING. Oil market continues to trade on expectations of an imminent resumption in energy flows from the Persian Gulf. This leaves significant upside risk as inventories fall and we move closer towards the stronger demand period of the third quarter. One of the things I'm seeing is there's not an adjustment by any of these analysts to the demand side. Um, and that's what I just spoke about. And I think that is one of the mistakes that is being made. Okay, when viewing oil, uh, oil prices actually traded lower on Friday, although they were still headed for a weekly gain after 2 weeks of significant declines, with oil holding back above 70. I think that the real test for oil comes when a deal is finally signed. Does oil fall and then stay down, or does it sell off and then rally again? Goldman Sachs partner believes that the latter will happen, that oil will sell off, but then rally again. I think that the longer this takes, the more destruction that is being done to demand, and the more likely you're going to see austerity measures, translation, rising interest rates in other countries. So I actually believe that other countries are going to have to raise their rates to support their currency. When they do that, it's going to reduce their exports, and that in itself will be demand destruction for oil. And it could happen very quickly, over a couple months. And so I wouldn't be surprised to see this summer, and I think it will happen, where you're going to see more talk about emerging markets in Europe demand destruction. And that's why I think that the price of oil is coming down by the end of the year to maybe in the $50 range. All right. So we looked at the markets yesterday. They were absolutely puked. Risk off sentiment change. Again, it was the market is saying the reason why was the hotter than expected non-farm payrolls. I just discussed with you all and shared why I think the payroll jobs number should not carry as much weight as the market is reacting to. That caused, as I said, yields to spike. We also had Broadcom's earnings the night before, and the mistake, or the reason why they got hit, is they did not increase their forward guidance. Very interesting. Then later in the day, we had Meta announcing a major secondary share offering, which prompted another leg lower right here in the markets. Okay. I thought that when I saw the headline come on, I'm like, you got to be fucking kidding me. Right. What a terrible time to announce an offering. But this turned out to be the NASDAQ's worst day and worst week since April of 2025, which was Liberation Day. And the Dow dipped into the red for the week at the end. The S&P had its historic weekly win streak broken, and that would have gone back to 1985. Okay. We had 1, 2, 3, 4, 5, 6, 7, 8, 9 straight weeks of green. And look, the market and participants and Twitter especially are completely freaking out because we are back where we were 2 weeks ago. I mean, that's terrible, right? Um, okay, the Mag 7 significantly underperformed the S&P 493 this week, and that should be expected with a lot of selling coming in these mega cap tech names, right? Semis, the Philadelphia Stock Exchange Semiconductor Index, or which we reference it, the SOX, experienced its Biggest daily loss since COVID. Bloomberg macro strategist Michael Ball said that today's pullback in equities is a repricing of the crowded AI capex leadership rather than a breakdown of the broader index rally. Right? Okay, so one of the things I want to comment on this, one of the things I've been keeping an eye on is the cost of spend for servers. And last week we saw a 30% move down. You can rent servers like Amazon Web Services. We do it with, or I do it with my bots. I've got a server in Tokyo for a latency R bot that I've been running. I will tell you that you don't reduce rates. So let's simplify this. All the companies came out, all the server companies, the hyperscalers came out, bought a shit ton of storage, right? That pushed memory prices up. That pushed everything up in the tech sector. And how they make money off of that is they lease or rent that server compute power to corporations as well as individuals. And what I saw last week was a I mean, it was a significant drop in rental rates, about 30%. If demand is so good, why are server rental rates coming down? Well, probably because there's too much build right now, and they probably hit peak demand here in the past month. So what else could happen? Well, we already saw this week Uber, as an example, limited their employees to only $1,500 a month in AI spend. Or a limit means that the corporations are no longer allowing their employees to just spend or use agentic AI anytime they want. Well, that's also a cap on revenues. And I think we'll see more and more companies do that. There was a company 2 weeks ago that had spent its entire annual budget, $500 million, yes, on AI. And it's interesting to me that the company wasn't named, but netizens who were sleuthing it believe it was Amazon. We saw there is a Domino's franchisee or Pizza Hut franchisee that is suing Pizza Hut for $100 million because he states that when they introduced AI into the system, it destroyed his profits. It didn't do anything right. So I think it's gonna be a very choppy area. I think that we're very near the end of this. Everything that is related to AI or hyperscalers should be bought. Okay. We're starting to now switch as we always do. This happened during 98 and 99, where people are starting to realize, and I've been saying this for a while, that AI, like any other technology, at the forefront is expensive to deploy, expensive to use. But just as servers and modems and all of that became commoditized, okay, that's going to happen with AI too, right? And so I think that at some point, and I believe we're at the start of it, we're not going to see the same easy money made in AI. I think more and more of the focus will be drilling down to each company's model for business as it relates to AI and their spend. As long as the debt markets continue to fund these ridiculous amounts of money. When Meta does this, what they're doing is they're raising capital so they can buy more, right? But I think we're at the front end of the first company that comes out and says they're done raising capital, or they're going to pause their capital raises. I think that's going to cause a tremendous amount of fear in the market. And that's when I think we could possibly get a crash. Okay. But let's move forward here. This was the effect of the strong non-farm payrolls jobs number. Bonds were absolutely, it was, as one trader put it, a bloodbath in bond land. As traders fully priced in a Federal Reserve interest rate hike by the end of the year after U.S. job growth topped all forecasts in May. Okay. And that spurred yields higher in the $31 trillion treasuries market. Interest rate swaps indicated traders now expect a quarter point increase in the U.S. central bank's target for the Fed funds rate by December policy meeting. I don't think so. I think Warsh is going to lower rates. I think and certainly after NFP, he left the door open to that. I think the market was looking for a reason to sell off. And I don't think the market right now cares much that 70,000 of those jobs were temp labor to deal with the World Cup. Okay. So I would say I'm an outsider or outlier. I believe both oil is coming down and I think interest rates are going to come down. Whether or not it's smart or not, okay, um, either one or the interest rate, I'm not commenting on that. What I'm saying is this is what I think will happen towards the end of the year, right? Okay, so let's look at the overall market. Here we go. This is gold. Gold is now below the 200-day moving average by the biggest margin since September of 2023. That wiped out all of the 2026 year-to-date gains. Okay. Gold and silver, the rest of the precious metals complex, this is copper, gold, silver, and platinum, was absolutely pummeled. And silver was probably the weakest horse in the glue factory, with now it is testing a key technical support level. Looking at Bitcoin, Bitcoin just got blasted below the 60,000 level for the first time since October of 2024. Let me see what it's doing currently. I opened a Bitcoin short on Friday via the iBit. I bought puts in it. I think that we're probably going to see more of this on Monday, and I'm going to get to what I think will happen on Monday also. But this is a 24-hour chart. This is a 1 week chart of Bitcoin. I think if there's any hope for the market to bounce on Monday morning, it's got to come out of Asia, out of South Korea. Okay. I've been commenting a lot about the fact that South Koreans have been, well, SK Hynix and Samsung helping really run the market up through irresponsible margining of real assets such as their houses. And at some point that will stop. And if South Korea also doesn't pivot to go trading Bitcoin again, I think Bitcoin's in trouble. I don't know about getting down to 20 or 30,000. I think at a minimum that next week we could see Bitcoin down to 50,000. Okay. I think that Sunday night when Asia opens, uh, uh, I think that's there going to be some carryover effect from the US markets on Friday. Although they started the problem with the night before, some of you may not be aware that on Thursday night, which would be Friday morning in Asia, the South Korean stock market actually paused when it was down when it was down 5%. It paused all algorithmic trading. Okay. And remember, this market during COVID, they prohibited short selling. So they are a much more active, their regulators are much more active than the US regulators. So maybe they go bargain hunting. I don't think so. I think there's going to be over this weekend a lot of fear if you are a Bitcoin holder because remember, a lot of this money is leveraged. I mean, they were talking 100 to 1, 500 to 1 leverage. And so margin calls are going to be, or currently are, going to be massive relative to the actual security or investment that you bought. You know, with stocks, when somebody got a margin call, you would have to sell between 2 to 2.5 times the dollar value of the margin call to cover the margin. And that's at a very, very one-to-one leverage factor of a broker dealer. Okay. We're talking, as I said, in the hundreds to one leverage factor. Okay. Take a deeper look at hedge funds and long only funds and the expectation of their order flow over the next couple weeks. This is nothing new. Semis and hardware now account for 35% of all hedge fund net exposure. So there is concentration risk right there. In addition, institutional positioning is currently elevated and not far from a record high with a 9.5 out of 10 in US equities. So, what do you take from that? Well, they're all in or almost all in. Okay. Then, what the hell is this chart here? Here we go. Where are they actually positioned? Large cap tech positioning is near the top of the historical band. Again, speaks to concentration. Let's take a look at CTAs or systematic strategies and what the expected order flow is going to be. Well, in a down market, they're going to be sellers of stocks of $149 billion. If the markets are flat, they're going to be sellers of 26 billion. And if the market is up, they sell 23 billion. In no scenario are CTAs going to be buying over the next couple of weeks. That's not good, right? That's a supply or demand, a very large demand variable for the overall market. And we haven't even gotten to talk about, the upcoming SpaceX IPO and what that might do to flows in the market. Let's switch back to emerging markets. Okay. Emerging markets, I really like watching the volatility of something number, right? This is the volatility, the VIX for emerging markets. And what do you see? Really elevated VIX compared to the US. Again, this supports my growing belief that the U.S., the rest of the world, if this plays out, is going to get hurt badly, okay, from an economic standpoint, while the U.S. continues to chug along and be the strong leader from an economic standpoint, a growth standpoint. I don't think it's a very popular view, but I truly do believe, and this is not to say that Trump is a genius, but he is a businessman. And quite frankly, the longer this war continues and goes on, yeah, it'll hurt our economy on a temporary basis. But there is more than one variable that affects total country's economic growth. We have to remember that with the U.S. having the reserve currency, the U.S. dollar, we can we've done it before. We can literally destroy a country. We've done it in Central America by causing their currencies to rise so much. I mean, there were stories, back in the 90s where I don't know if it was Brazil, where people would get paid twice a day. They get paid at lunchtime so they could go out and buy, and then they would get paid at dinner time because by the time between lunch and dinner, the cost of bread would be up another 100 or 200%. The US can destroy countries just by the US dollar. And I think a lot of focus is on oil, but at the same time, very little focus is on the strength of the dollar and what that does to other countries. Another thing that wasn't made a big deal out of, but when the United Arab Emirates or left OPEC this spring, um, to me, that's the first sort of chink in the armor. Okay. So you've got OPEC, who has been the de facto, they set price in the oil market, right? They control the amount of production, and that's how they set price. And UAE said they're not going to do that anymore. So, exactly how long do you think it will take for the remaining OPEC members to maybe take the same route when the UAE is out there selling as much oil as they want at any price, disrupting the Middle Eastern oil market because they're doing what's best for their country? Okay. In addition, we have Venezuela. So now that we have the US, when I say we, have replaced the leader, Mr. Maduro. Maduro's been in prison and he's in US and New York. And I think he's singing like a bird. I think he has effectively becomes state's witness. And I think there's going to be, this fall is going to prove to be extremely interesting. A lot of focus is on the midterm elections and the belief that the incumbent party does not win midterm elections. And yes, the Democrats are doing everything they can by supporting the message of their most radical members of the Democratic Party. But on top of that, you have Mr. Maduro is in prison, and I think he is singing like a bird. I think that the U.S. government, I think there is connection between um, the drug business and where that money was going. I think there were U.S. political leaders that were taking payoffs. I think it was also directly related to 2020. And I think that could be maybe perhaps the October surprise that Trump's got to do something in the midterms, right? I think that could be it. And directly related, let me get back to my point here. Venezuela now has what 1.2 to 1.4 million barrels per day in production. Now that those barrels were not on the international market. That's about a half a billion barrels of supply on an annual basis that is coming to market. Uh, Iraq, to put it in perspective, is like a billion. When we look at the demand side, if you have falling demand, as I've mapped out, and then you also have increased supply, that's not good, right? I mean, right now the countries are they are avoiding largely increase in oil demand because they're depending upon their reserves. That's what reserves are for, by the way. And so I think that you could have the trifecta of uh, news or events that could really push oil, and I think we will go down to $50. Okay, that's what I believe based on my analysis. Their market is underestimating and not paying attention to demand destruction. We also will have new supply. We already do coming on the market via Venezuela. If the Iran war gets worked out, that's going to be additional oil that comes on and traded through the global oil market. So there's more supply. So I think the market right now, and we're going to get to some charts too. I think the market right now is pointed in the wrong direction. I think what happens on Monday or Tuesday of next week, whether we get a further drawdown, and I'll pull some charts here and show you what I think. Um, is I'm looking further out. I'm looking at further out as why would the market continue to rally? We're going to have a continual adjustment in the tech sector and memory and software, as in the advent of any new technology, you're going to have this massive amount of money that pours into it. But at some point, and I think we've started that, at some point, uh, the market itself will start setting prices for whatever benefit that new technology provides. So a lot of times it takes years. Sometimes, and in this case, I'm not saying that we're going to have a index of, and we should do this, but an index of compute power costs, and you could trade that. But I think those costs are coming. Well, I know they're coming down already, and I think it's only going to get worse for the hyperscalers. Okay. One final note: I think AI is sort of a scam because all it does right now is mimic. It's a very good mimic. Now, the argument is, as more and more companies and people use these large language models, they'll get better and better and smarter and smarter. But I think that the use of the word smarter or intelligence, it'd be like saying a parrot who can talk, who's mimicking a human being, is smart. No, I don't believe so. I think that AI is that sector, and whether it drags down the rest of the market, I don't know. But I think AI right now is not as advertised. Before I continue that thought, this is the to leave you with this. This is the leverage beta or the leverage bets on the Korean stock exchange. Unbelievable. Unbelievable. This is not good, right? That's not what you want to see. Oh, and some good news, by the way. So these are dark pool numbers on Friday. So the Qs, there were 2.6 billion to buy, 1.8 billion to sell. The Qs actually in the dark pool, they were buying at the tune of 847 million. Spies the same thing, almost $1 billion worth of buying net on Friday. And so this would what I think is going to happen on Monday, and it's going to depend on Asia, a lot of it, but I think there'll be an attempt at a bounce. Now, if on Friday night or on Sunday night we get massive selling because just merely due to margin calls, okay, that we get massive selling in South Korea and in Japan, okay, then the U.S. market will go down first Monday. There's going to be an attempt at a bounce. Why do I say that? I just showed you what was going on in dark pools. There were net buyers on Friday, okay, in the Qs and spies, and they intend to make money off of it. So I do think there'll be an attempt at a bounce. My plan is for the trades that I'm in, I'm going to use that bounce to exit at a better profit or better at a lower loss. Okay. I've accepted I'll take a loss on them. It's not a big deal. Losses occur, but I want to, if on the other hand, Asia rallies on Sunday night, then we'll start off with a rally, and I think it gets sold into, by the way. I don't think it drops dramatically, but I don't think the selling is done, is my point. And my hope is that we get a bounce. And my plan is that any bounce we do get, I think that we have to expect it'll be sold into. Okay. Um, and looking at the hyper liquid market, which is a 24/7 market, a lot is being made about the SpaceX price on the hyper liquid market, but I wouldn't. You know, they're talking, well, it was at 220 and now it's down to 175. Look, he's priced it at 135. Also on Friday, that got lost in a lot of the noise was that Google announced they were going to be paying SpaceX $920 million per month for AI computing capacity. Whoa, wait a minute. Uh, I thought Google was the compute capacity company. So here we go. The deal grants Google access to approximately 110,000 NVIDIA GPUs housed in SpaceX Colossus data center. The contract is worth roughly $30 billion. Um, and Google described it as a bridge capacity to meet surging demand for Gemini enterprise AI platform. This follows a similar deal with Anthropic. So SpaceX total committed compute revenue is $70 billion. So, but here's the interesting thing: netizens, or whatever they call them these days, people smarter than me, took the time to read the filing from Google, and there's literally 20 or 30 ways they can get out of the deal. In fact, it includes a 30-day cancel clause. So, do I think that this is intended to help the SpaceX IPO? 100%, meaning the news release itself. Trying to create that, hey, we have revenues greater than 3 billion. And so our valuation should be over, the 1.25 whatever trillion dollars they have it set at. After a day like yesterday, it's very important that what I try to do is, first of all, I take some time to absorb it, but I go right to the charts, right? Support and resistance levels and technical trading actually, to me, become even more relevant during periods of high volatility because you have more participants or more volume from bots and algos. I would actually say that, and I did challenge somebody on Twitter that he had said, oh, it was a bloodbath. It wasn't a bloodbath. Not when you have dark pool activity of almost $2 billion in buying net. Okay. I think a lot of Friday's action was algorithmic driven, right? Hits a level, keeps going, hits a level, keeps going. And that was the easy money to be made. I saw no attempt by zero DTE. So whoever it is that wants to move the market higher, I didn't see any of that. I don't think that this is the start of a massive move downward. I do think though that there's coming a maybe faster or sooner than I know or I've estimated a day of reckoning for AI. And what's interesting is Trump floated that he believes the US government should take investments in AI companies. He's invited the largest ones to next week to the White House. So now the market participants are trying to play, whack-a-mole by guessing which companies are going to be invited to that summit, and where he probably will announce something like they're going to invest in AI companies. Everything is being done, that you possibly can to support this industry. But I believe that the day of reckoning is a lot closer than people may want to admit, where companies are going to be judged on what's their return on investment for all this capital spend. I'm not going to go over each individual stock. Again, I think no matter what chart I pull up here today, we are trading in the same range on the 45-day, okay, standard deviation channel that I use. It's at the bottom end. Could it shoot a little lower? Sure. Is it going to go to 7,000? I don't think so, because you got the 50-day here, and that would be a two standard deviation move. I don't think so. Looking at the Qs, NASDAQ, same thing. 45-day channel here. It's back touching this orange line, which is the -1 standard deviation. But I'm not seeing, first test is going to be down here at 700, 693-ish. And then your next test doesn't occur until down at 667. So let's do a little math. The Q's closed at 705. If we get down to 668, that's 37 points. That's an additional little over 5%. Whoop-de freaking do, depending on if there's that morning or overnight weakness in Asia. Okay. You may wake up if there's not, and the market just pops, right? No, as much as I think that this isn't going to turn into something huge, my definition of huge is not if it drops another 5%. That's not a big deal to me. I think that's completely healthy. Not what the market's going to say, but that's what I believe. We have three stocks we are in that we got murdered on Friday. So here's how I look at this. When I go into a trade in this environment, I've been saying it for now 4 weeks. Look, every trade we take, we're playing with fire because of the overall lack of depth for this rally. And we've talked about that for weeks, that this is a very dangerous time. And you got a war going on, you have this big AI spend going on. I mean, it's a very dangerous time in the market. And so, instead of my portfolio being up 36%, if I took 100% loss on my free positions, okay, well, whoop-de-doo. The total of them is 5% of my total portfolio. I lose 5% if all three of those positions, due to the way I allocate, were to go to zero. I don't think that's going to happen. Okay. Because markets don't go straight up or straight down. I'm going to have an opportunity, I believe, to minimize those losses. However, let's say I don't get that and I lose 100% on those trades. So instead of being up 35, 36% for the year, I'm up 31, 32%. Plenty of time left in the year uh, for me to hit my minimum target of 50%, 50% annually. Last year at this time, my model portfolio was down 32% because I had taken some very, very large position on the VIX starting in the June before, due to the election and due to Trump. And they didn't pay out. So I started the year at minus 32%, I think, 36%. And by this time last year, I was at minus 32. I finished the year plus 89%. My goal for this year is always a minimum of 50% in my trading. Internally, I think I can do 70 to 85% this year. And that's just looking at the statistics of the last 28 years of trading that I've done this in using this methodology, and over 10,000 different trades. I'm very comfortable with stating that 50% shouldn't be a problem. By the way, if I get any help from EOSE, You can't look at any stock you own. Okay, do not look at Friday. Try to interpret that as weakness in the stock itself. It's not. Companies that I am looking at adding, if and with what price level. Okay, if the market really craters down here and we get PCT down around that 10 or single digit level, I've had some conversations with Billy. I've talked to a couple other people. Mr. Greg Ray's has been pounding the table on it. I really like PCT's business. Okay. And this is something that I will probably write puts on, because if it got down in the 10 or the 9 range here in the next week or so, right? I would like to own PCT on a longer basis. EOSC. EOSC is simple, folks. As soon as if they get the New York deal and it's announced, we're going to see an immediate re-rate of the stock. So how low do I think this move can go? Well, $6. If it gets down there, I'm going to write puts. Absolutely. Other than that, I mean, looking at the overall market, I'm in Hymex. I mean, all the charts are going to look the same, right? I am short of IBIT, and that's a ETF for Bitcoin. And I want to add in on IBIT. I'm looking at November's to add in longer calls, because I do think the price of Bitcoin is going to go much lower than it is, right? I'm in Nokia, ugly, ugly chart, right? We will have to wait and see what Monday brings. Okay. So I don't think it's the end of the world. I think, generally speaking, it was a lower volume. It wasn't a 9 out of 10 in activity. I think Goldman put it at a 6 out of 10. And there was quite a bit of buying going on in the dark pools. Okay. So I'm looking at Monday to sell the RIP, because ultimately I think that there is more selling to be done. Obviously, CTAs are positioned to sell in the next couple weeks, and I am. A lot of my opinion is based upon what I think is going to happen with South Korea when that market opens, and largely driven by margin calls. So, all right, have a great weekend, and thank you for listening, and I will see you all next week.